Starting with AS7. AS7 title is Construction Contracts. This standard deals with recognition of revenue. This standard should ideally be learned after AS9 because AS9 is a standard which only talks on revenue recognition. Whereas AS7 also talks on revenue recognition, but only for one specific industry, and that industry is construction industry. Any revenue of contracts that are construction related, and what construction related contracts it talks about? Contracts which generally span for more than 12 months. The contracts is for more than 12 months. Let's take some 2 to 4 years contract it is. And this contract is on constructing any asset, in the sense building, bridges, railways, or any asset which takes more than 1 year to construct. Along with recognition of revenue, this standard also talks about recognition of cost on the contract. Hence, if I have to tell what is the objective of learning the standard, objective is to understand when to recognize, or I tell how, no need when, how to recognize the contract revenue and contract cost. When it comes to contract, there are two parties to a contract. One is the contractor and the other is the contractee. We are going to talk about accounting only in the books of contractor, because that is the person who is earning revenue on the contract. This contractee accounting is outside the purview of the standard. This will not be discussed at all. Scope, not so much essential, so I'm not talking about it. We will start with recognition principles. Recognition of, I will write recognition criteria I'm going to give you. The standard tells that when you have for recognizing contract revenue and contract cost, we need to check whether outcome of the contract can be estimated reliably. Outcome of the contract can be estimated reliably. Which means I have started a contract, I will be able to complete the contract, hand it over, and I am going to receive the money. If this entire process is very clearly estimated, we can find out that if we start, we will be able to complete. If we will be able to complete is the answer. Outcome can be estimated reliably, yes. If outcome cannot be estimated reliably, accounting goes different. So first thing in any contract you pick up, you should know whether the outcome can be estimated reliably. If yes, first thing I will talk about how to recognize contract revenue. If outcome can be estimated reliably, what you should understand, the contract will be, we will complete it till the end. We will hand over that asset to the person and we will get the money. The entire process can be estimated reliably. In that case, which method should you recognize the revenue? We need to understand now. This standard talks about only one method to recognize, and that is percentage of completion method. Percentage of completion method. If the outcome cannot be estimated reliably, which means you do not know whether you will be able to complete or not, whether that person will accept the asset or not, there's some problem happening in the contract. In that case, we will tell that outcome cannot be estimated reliably. In such a scenario, the accounting of revenue, how will you do? I'm going to talk about it. This scenario will not be asked in the exam. Whatever scenario given in the exam question, it will be where outcome can be estimated reliably. No means we will recognize revenue to the extent of cost incurred on the contract. What do I mean by this? If I recognize revenue to the extent of cost, am I recognizing any profit on the contract? No. No profit should be recognized in this case because we do not know whether it will be completed. Outcome is reliable. Outcome cannot be estimated reliably. In that case, no profit should be recognized. Instead of telling this to you, the standard tells that recognize revenue only to the extent of cost incurred. Henceforth, our discussion will only be on this zone where outcome can be estimated reliably. I'm going to continue with that only. Percentage of completion method. Percentage of completion needs to be calculated first. How will you calculate the percentage of completion? There are two ways. One, you go to the site, look at how much of construction has been done and tell that this building is constructed 60% or 70%. You personally go. If I don't understand the percentage, I take one technical person. He comes and he tells that this building, if it is constructed so much, it means it is 60% done. That is called a survey method. But in exam questions, you will not be given survey method. They will ask you to calculate the percentage of completion. How you do that? You will take cost as the base of finding out the percentage. How means? So the entire project can be completed with a cost of 300 crores. We are looking at it from accounting viewpoint. So if we go to the accounting department, we will get this information. The proposal will have that our cost expected on the contract is 300 crores. Then I will take out the books of accounts. From books of accounts, I can find out this is the contract cost on the total contract cost. Okay. From the books of account, I can find out how much of cost has been incurred till date. Till date cost incurred is 200 crores. I will take cost as the measurement base and find out the percentage now. How will I find out? Till now 200 crores. Total contract cost is 300 crores. How much of, what is the percentage we can find? This method is called as percentage completion method. So whenever in our exam question they talk about revenue recognition, step number 1, you will have to find out the contract cost, the percentage of completion for which you will use contract cost. Having found out this, next. I'll cover off contract revenue and contract cost meaning and we will do a question. Then I'll come back to the other provisions. What all should form part of contract revenue? What all should form part of contract cost? Mostly questions are tested on this on this model only, or on these provisions only. Contract revenue. What all forms part of contract revenue? I'll just list them down. First is whatever is the contract price agreed upon. There are two types of contracts. One is called as fixed price contract and the other is called cost plus contract. You're aware of it? No idea? Okay. At least Santosh is nodding his head that yes, he knows something about it. Again, I'll tell you which one generally they give in the exam also, I'll tell you. Fixed price contract. This is only for you to understand. That's why I've given it, I'm writing it separately, not as part of that book. No provisions on this will come. Nothing is going to be asked on this. Cost plus contract. Vikram is our builder. We are going to give, he has got a contract to construct something like that SPR building in Perambur. There's big Casa Grande, lot of big real estate developers. So he is having a contract to develop a building in, let's take Gudvancheri. In that place, he is going to construct a big residential complex. There are two ways in which you can propose and get the contract. One way is he tells whatever this entire residential complex, I will construct and give it to you in 400 crores. In that case, he is fixing that for this totally 400 crores I will charge. Or else, there is another way in which you can get the contract, which he tells, whatever I spent, whatever is the expenditure, plus 20% profit margin, you give me the value. Whatever expenditure incurred on the contract, it's a cost plus margin will arrive at the selling price. In our exam questions, they will not ask you on this, they will only ask you on this. They will tell you this is not working. Okay. Anyway, they only ask you a fixed price contract. They'll give you one contract revenue is the entire contract is for so much revenue. Okay, so contract price that is agreed upon. Ideally, this only should be the contract revenue. But in some situations, you start the contract by agreeing upon 400 crores. As the work goes on, we make some modifications to the design on that Gudvancheri, our residential complex is coming up. We are now telling him, you also include a gym and a swimming pool there. We are varying the contract. Any variations made, he is going to charge me extra revenue from me. So any variations is going to increase the revenue because he's going to charge extra from us. From me means I am the person who is giving in the contract and the contractee is the contractor. Any variations made. Then there could be another clause in the agreement called escalation clause. If you remember learning AS7, you would have come across this word called escalation clause. Escalation clause is where we entered into a contract in 2024. This will go on for 4 years. We have an escalation clause embedded, which means maybe after 2 years, suddenly there is a rise in the cost of steel prices, increases. He will tell that because of steel price increase, I am escalating the cost by 5% or 10%. The escalation clause will be agreed upon in the beginning itself. So if that escalation clause is there, then it will increase his revenue. You need to know which is going to be added to the revenue and which will be deducted. Okay, whatever is going to add to the money in his pocket, it will be added. Anything that he has to will decrease his money in the pocket will be deducted. Escalation clause, he will charge extra from me. That's why it's going to be added. Next, 4 years period agreed upon. As the contract progresses, I want him to complete it faster because I feel there's a market demand now. I might as well sell the plot immediately. So I tell him, you complete it quick. I will give you some incentive for quick completion. In that case, it's going to add to his revenue. So it's going to be added. One more item. Say he has to pay a penalty because he has made some mistake. I asked him to do it as per one particular specification. He did not follow my specification. I will charge penalty from him. Or he did not complete within the time period I told him to do it. I will charge penalty. Add or minus? Minus. It is going to reduce his revenue. So this is the only item which goes minus. In the exam questions, how will you find it? They will give you one contract price, and then in the between, when you keep on reading the question, somewhere they will tell at the end of second year some variation in contract revenue happened, or at the end of third year escalation clause was brought into effect. So when you're calculating, how will you do? You will start with year one. Year wise, you have to calculate the revenue. How much every year you have to recognize revenue. For that, you will start, say 400 crores agreed upon. So the first year we are going to take 400 crore total revenue. Second year total revenue 400 crore. Then at the end of second year, let's take that variation happened. 20 crore extra I have to pay to him. So from third year, I will take revenue as 420 into my calculation. Say in the fourth year again that some 10 crore something happened. We will take it as 420. Okay. Based on this, we'll have to proceed with the calculation. First point, the contract revenue is clear to you. Now I'm moving to contract cost. Contract cost is not going to be so much tested in the exam. Meaning they're not going to give you some different items and test you on contract cost. Contract cost I will tell you. Cost means material, labor, overheads. Then overheads can be either variable overheads or fixed overheads. Under fixed overheads, if it is directly related to the contract, you will add it here. If you cannot directly relate it, you will ignore it. For example, admin overheads will not come, selling and distribution overheads will not come, only construction related overheads will come. Nothing much will be tested on this. Only two things which you should know in this area is as follows. You will surely note it down. The following are not part of expenditure. I'm just telling it, I'm not writing it on the book. The following are not part of expenditure but should be recognized as an asset. But should be recognized as an asset. First one, cost of material transfer to contract site. Transfer to contract site, but not used. But not used. We have issued the material to our contract site. The moment we issue, we will take that as material cost. But it is not used, which means it is lying in the closing stock. Is closing stock part of cost? No, it will go as an asset in the balance sheet. That's what it means. It is transferred to the site, which means we have made an issue. The moment we make an issue in accounting or in costing, we will take it as material issued and take it as cost. But from that cost, we will deduct because it is lying unused. So in the question, exam question, what they will tell you is, they will tell you the cost is say 300 crores. And then somewhere you will find that some material transfer has not been used. Say 5 crores. I'm just giving big numbers. 5 crores. What will be the cost for that year? 295 crores only you will take and you will move forward. One more item which will not form part of cost is, you listen to it first, then I dictate it for you to write. I am the contractee, Vikram is the contractor. He is having the contract to construct residential complex in Gurvancheli. It's too big for him, so he now subcontracts that contract to others. You know subcontracting? Under him, another person is going to work. So let's take Santosh is that subcontractor. In whose books are we doing the accounting? Vikram's books. He is the contractor. Vikram has subcontracted this complex alone to Santosh. Any payment made to Santosh, in Vikram's books, it is going to be an expense, able to relate it. The moment he makes a payment, it will be payment to subcontractor, it is an expense. So apart from material cost, subcontractor fee or money paid to him is also an expense. Say money paid to Santosh as an advance. Will advance payment be treated as cost? No. Advancely, if you pay, it is not an expense. It will be taken as an advance and taken to the balance sheet as an asset. Maybe next year when that may be recognized as a cost, but for that year in which advance is given, it will not form part of cost. You will have to deduct it from the cost. Okay, so these are two items only they'll test you in the exam. Either material is issued to the site but lying unused. It will be part of asset. Advance given to, it is a payment made to subcontractor as an advance payment. These two will not form part of cost. That's all. With this understanding, let us begin a question. I saw questions only on this model, most of the questions, under percentage of completion method. 37th question we are starting. Vijay, today I'm seeing Vijay, someone new. Good morning, Vijay. I hope you have the soft copy of the handout, because during the class I may be screening, I may not be screening once a while, because I will be writing the details given. I hope you have, if you have some other device, you open that handout from that device. Okay. Construction Limited is engaged in the business of constructing flyovers. It obtained a contract from some authority for 400 crores. Oh, coincidence that even I took 400 crores. Oh. Construction is expected to be completed in 4 years. Mostly it will be for more than 1 year contract only you will have. At the outset of the contract, it was estimated that total cost to be incurred on the contract will be 370 crores. Whenever you read a question, another check which you should do is, when you read the contract revenue and the contract cost, you should check whether you are going to make a profit or a loss in the contract. Here, it's a profit. If it is not a profit, say it was the other way around. Contract revenue was only 370 crores, but you are expecting to spend 400 crores. On reading itself, you know it is a loss. And according to prudence concept, what should you do if you expect loss? Make a provision now. That I will cover it in some time. But if you remember reading AS7, there is something called expected loss on a contract. That you should check when you're reading the first line of the question. That should work in your mind to check whether there is an expectation of loss or it's an expectation of profit. I'm reading further. This question is not on expected loss, so I did not cover that provision so far. If you did not understand, forget it. But by the end of year 1, this estimate stands revised to 375 crores. Again, it's well within 400 crores only. By the end of year 1, it is changing. During year 3, the Construction Limited requested for a variation, which was approved, and total contract value will increase by 10 crores. This 10 crores should be added to revenue or cost? Cost. Variations was proposed. Total contract value. Value means it should be added to contract revenue. And cost will increase by 7 crores. On one side, you're getting a revenue extra of 10 crores. On the other side, you have to spend extra 7 crores. Okay, how we will do with it? We are going to work out the question. Decided to, okay, it is going to use percentage completion method. Every question in our exam will use percentage completion method only. They are going to estimate based on the cost. Contract cost at the end of each year is given. Now, this cost which is given, is it a cumulative basis cost or that year cost is given? Cumulative. Read the cost. It ends with 382 crores. It is cumulative cost. Okay? Just note that in your mind. And the next thing is this. I told you, 2 items will not form part of cost. 1 item they've used in this question. Generally, they will use, I have seen questions in material, whatever, with this only more adjustment. Rather than that advance payment to subcontractor, very less possibility of that. you're asked to calculate stage of completion, profit to be recognized. Which means, what are you to find out? One, stage of completion, which means what all you require. We will map the steps now. How are we going to approach the question? First is percentage of completion. To find out percentage of completion, the formula is cost incurred till that date divided by total cost on the contract. Into 100. We will do this first. Next, we need profit. Profit is nothing but revenue minus cost will give you the profit. So the second step will be to find out what is the revenue to be recognized each year. If I have this, the third step we will have revenue minus cost incurred, we will have profit. Revenue of each year minus cost of each year will give us the profit of that year. This is broadly the steps in which we are going to approach. Let us start with percentage of completion. You will write down percentage of completion. We will have a particular column. 1, 2, 3, 4. 4 years. We will start cost incurred till date. That's only a numerator. Cost incurred till date. From the material, from that material we'll pick up, we'll write the numbers as given. Okay, 98.8, 202.4, 310, 382. Next line, minus unused material. In year 3, there is an unused material of 3 crores deducted, 307. Other numbers come as it is. If you want, you can do it just like 310 minus 3 also and show it. But first question, let the workings be very clear in your mind. There is no harm in going one step extra if that step can avoid mistakes. If you finish quick, but if it is wrong, no point in finishing that answer quick in the exam. Cost incurred till date is so much. What is the denominator for us? Total contract cost. Let's write down total contract cost. Vikram, first year end. We are going to go year wise. What is the contract cost which we should write?
370.
370, is that right, Subha? It's not right. Please read the question again.
But by the end of year.
End of year 1. We are going to do this at the end of year 1.
375 at the end of year 1.
First year. Correct.
So at the end of year 1 till year 1 end, we have incurred 370.
Ilakana, this 370, we are not incurring. We are only estimating. Incurring is only 98.8.
Okay.
See, 370, you gave me the contract. My department has estimated that this cost will come to 370. They estimated that. Based on that, I proposed to you. You agreed for 400 crores. At the end of whatever we are doing now, is it done at the beginning of the year or end of the year, this calculation? End of the year, because at the end of the year, you're going to find out percentage of completion. Why are you finding percentage? To know how much of revenue to be recognized. That is the reason why you're finding percentage. How much of revenue to be recognized will be found only at the end of the year. So at that time when you're calculating percentage, the estimated cost is revised. Total cost on the contract, how much is our estimate that we are going to spend? 375 crores. At the end of year 1 itself, we will start with 375. 300 was made at the beginning of the year. We are not doing this calculation at the beginning. Total cost on the contract estimated is 375 crores at the end of year 1. Okay, moving forward, the next change happens when you will have to continue at the end of year 2, what will be the total contract cost?
Yeah, same.
Same, 375. End of third year.
Let's say
3
Not 385.
plus 7.
382. Exactly. 375 plus 7, 382 is the contract cost total.
10 is for price.
Year 4. Price, forget it. We are not dealing with revenue now. In this calculation, it's only on cost. 382. It matches, which means we estimated 382. Our actual also 382 only it came to. Till here, are you with me? Moving forward. This model question, very important for AS7. Only this model is something which they can ask in the exam. Now we have to find out the percentage. Please calculate and update in your notebooks. I will do 98.8 divided by 375 percentage, 26.35. I hope you please check your percentages whether you match it with this. Okay. Now contract revenue, total contract revenue. I'm going to write the revenue numbers. Then we will find the percentage on that. Okay. Continue, Subha. First year, what will be the revenue I write here? Second year.
400.
Third year.
410.
Yes. Contract revenue to be recognized. Please apply the percentages on the numbers and update now. Subha, these numbers, no, are they on cumulative basis or per year basis? Per year. For the first year, you will recognize so much in P&L. For the second year, so much, or this includes this. How do you find out that? What is the last year revenue? 410. Total? Totally so much, or in that year you have earned a revenue of 410. It's cumulative basis. Everybody understand what cumulative means. No, I don't have to explain what is cumulative. Now, so far our calculation entirely was on cumulative basis. But What is the question asking you?
Correct.
Profit for each year you need to find out. So profit for each year, to find out what do you need? Revenue of each year, cost of each year. If I do 1 minus 2, I will get the profit of each year. So leave one line gap in the table and continue in the table. Revenue for each year. It means contract revenue. I'm not writing the word contract. Next time you will write, or okay, I'll write of contract cost of each year. Can you please calculate it? If you can do it, I will understand that you know what is cumulative basis. That's all. Finish showing cost also. I will one screen my answer picture. No, what?
7.6. 72.
Which one?
For the last 2 years. That is 3 and 4th year.
Mm-hmm.
I got 107.67, 72.
This morning only I worked out the question. I got these answers.
Yeah. What about the second?
The same only, 104.6.
Workings?
Which one? We are talking about contract revenue or contract cost?
Cost.
Cost. You got these answers? Or your answers differ from this? Same answer, same answer. Okay, I'll show the working. This number you have a doubt. This number is 307 is the contract cost incurred till date, minus the previous year 202.4. You will get this number. Some number mistake only you would have done. Now please find out profit for each year. 1 minus 2, if you do, you'll get the profit for each year. Please do it. That's all. Question is through with. It's a very, very simple question. Seven-mark question. Check your numbers after you're done. Okay, let us move to the next question. Thirty-ninth question we are coming to. We have totally 6 questions placed in the material for this. We'll work out all the 6, even though it is all the questions except for one question is on percentage completion method. So 5 questions are only on percentage completion method. 38th question only is something else. So I will come to that last. Now we will go a little faster. On 1st December, on 1st December, GR Construction Company Limited undertook a contract to construct a building for 45 lakhs. The company found that it had already spent 32.5 lakhs on construction. Additional cost of completion is 15.10 crore. The moment I read contract revenue total, contract cost total, please do it in a calculator. Check whether the contract is going to make a profit or loss for us. It's a loss. Expected loss. At the end of the last step in the question, we will come to and say that this is an expected loss. How to deal with it, I will take it through afterwards. At what amount should be charged to revenue? The question is asking you how much of amount will be taken as revenue in the final accounts. It is not asking you how much of profit, unlike the previous question. To find out how much of revenue to be taken, you should know what is the percentage of completion. Percentage of completion, what is the formula? Can we repeat it? Cost incurred till date divided by the total contract cost into 100. Cost incurred till date is how much? 32.5 divided by total cost. Please do it in your calculator. What is the total cost? 32.5 plus 15.1. 47.6. So total contract cost is 47.6. Numerator will be 32. Pen is not writing very clear here. 32.5. Please tell me what is the percentage of completion? 68.28. 68.28%. That's the step 1 we've completed. I will share the solution key to you. If required, you can go through it. This I'm not going to make you work out. It's very simple. We'll do it in the calculator itself. Finished. Okay, this is the percentage of completion. Tell me what is the revenue to be recognized now? What is the total revenue in the contract? 45 lakhs. So 45 into 68.28%. What is the revenue? 30.72673. It is so simple that in the calculator itself you can finish it. That's simple. 6, 7 questions are actually. Okay, we are done with this. Now, step 1 is done. We have found out what is the revenue to be recognized. The next step, we are doing it because we understand something more than what question is telling us. We'll have to tell that the cost to complete the contract, the total contract cost exceeds the contract revenue. The total contract cost exceeds contract revenue. So there is an expected loss on the contract. It needs to be recognized by way of a provision. It is not actual loss. It is only we are foreseeing a loss. Any possible losses, we'll have to make a provision. Journal entry, can you just tell me what will it be? We will debit or credit provision. It will go as P&L to provision. Okay, in your mind you keep that journal entry. Tell me what is the number for loss. We'll see how the presentation happens in the solution. Total cost is so much, total revenue is so much, total foreseeable loss. This word I want you to use. You will not write possible loss, you will tell foreseeable loss. For now I am foreseeing a loss of 2.60, which will be recognized. Here the word expense is given, but which needs to be provided for, you will write. Don't tell it as expense, you write it as which needs to be provided for. The expected loss should be recognized as expense immediately. Okay, you write it recognize as expense. The suggested answer tells that you write that, because I read somewhere else as provision, but anyway, you write this itself. Should be recognized as expense immediately. Moving to the next question. Rows constructions also, we'll finish it. Same model. Quickly we'll do it in the calculator. Rows constructions undertake to construct a bridge of Uttar Pradesh. The contract is fixed at a price of 12 crore. There is an escalation clause. And then we'll read further. Cost incurred up to this date. Cost incurred to complete the contract. Escalation clause is 5%. Contract price also increases by 5%. You're required to find out what is the percentage of completion. Can you find out the percentage of completion? Then we'll discuss. Now that 5% escalation cost, they presume that the 6 crore which is given there, cost estimated to complete, is already considering the escalation clause. What is the, okay, first, what is the percentage of completion using the numbers here? Cost incurred till date is 4 crores. Total cost is 10 crores. 10 crores. Total contract cost 10 crores. Escalation clause, any number. Date is given, nothing is given. How the material is worked out is 4 crore divided by 10 crore. 40% is the percentage of completion. They have not taken it as 10 crore plus 5%. That is not the way they've taken it. I think they presume that this estimated cost to complete 6 crore already includes this escalation clause. See, this is the percentage of completion. But the contract price, what they've done is 12 crore is the price agreed. 12 crore plus 5% on that comes to
12.6.
12 plus 5%, 12.60 crores. On this, apply 40% and you will get the revenue to be recognized. Into 40%, you get 5.04 crores. So the revenue to be recognized is 5.04. But the question is not only on revenue recognized, they are asking what is the profit. How to calculate profit? Profit minus cost. Cost incurred till date is how much? 4 crores. Able to follow? If not, I'll work out the question again. No?
5%. Is it increased due to escalation clause or another 5% is increased? We are doing both to 5%.
Hence,
Contract price is
Exactly, that's what I'm telling. Okay, I will
escalation
move it
cost
here.
is-
Cost till date 4 crores. Cost to be incurred to complete the contract. Cost to complete. I'll write that. Cost to complete the contract 6 crores. Total cost 10 crores. Then the question tells contract revenue price 12 crores. There is an escalation clause. Escalation clause at 5%. What the question has worked out solution is, they apply the escalation on the contract price. Okay, so there is a 5% increase in the price. If I do 5%, it comes to 12.60. Escalation clause applied. But this escalation clause has not been applied on the cost. Probably the presumption is they are giving you what is the cost to complete the contract. They presume that the 6 crore is after considering that escalation clause. So the escalation is not done to the cost. Escalation we've applied only on the revenue, on the price. When you read the question, there are two 5%, as you tell. Escalation cost is by 5%, price by 5%. But this in the solution, if you see, it is not being done. You may have to write the assumption. This is RTP Jan 25. This is the solution from that material. Am I clear on that? So on escalation, for working out percentage, I'll find out 4 by 10, 40%. This 40% I will apply on 12.6. I will get 5.04. This is the revenue. So profit will be equal to revenue 5.04 minus cost incurred till date 4. 1.04 is the profit. Question ends. Is there any possibility of loss on the contract? No possibility of loss because 12 is the revenue, 10 only is the cost. So there is no possibility of loss. Okay, next question. Mehta Limited question. That's the last question. No, there's one more question. Mehta Limited will work out because there are different year wise you have to find out. It's better we work out. Otherwise you will feel lost. You may get confused. Contract price 85 lakhs. Material issue 21 lakhs, out of which material costing 4 lakhs is still lying unused at the end of the period. If you remember, this will not form part of cost. I had spoken about it. Labor expenses 16 lakh, out of which 1 lakh is still unpaid. Specific contract cost 5 lakhs. Subcontractor cost 7 lakhs. Advance paid to subcontractors 4 lakhs. So they're testing you on cost components also in this question. Cost estimated to complete the contract is very simple, given as 35 lakhs. You're asked to find out percentage of completion, contract revenue, and the cost to be recognized as per AS7. Profit is not asked, only cost and revenue is asked. Step number 1 will be, you need to find out the percentage of completion. For percentage of completion, what is the numerator? Cost incurred till date. Cost incurred till date, is it given to you directly? It is given in different components. So step number 1, we find out what is the cost incurred till date. Please find out cost incurred till date. You will write working note number 1 or whatever. Even if you write in short forms is okay, but please make sure you work out cost incurred till date. Material, write the number. Labor, write the number. Which question is this? Raj construction. I told some question, I read another question. Sorry, I told I'll do Mehta Limited, but I read Raj Construction Company. It's okay, do it. It's only for 1 year only. What is the contract cost that you're getting? It it will not take me much time to work out, but only if you work out, I will know whether you understood. That's why I'm not doing it. Jyotika, what answer are you getting? Sneha, what answer are you getting?
41.
41, no? No, 41 is not right. Sneha, what answer? Pon, what answer? This is so difficult. Material 21 minus 4, 17. Labor cost, that's 16, out of which 1 is still unpaid. Do you have to deduct 1? Will you take 16 or will you deduct 1? 16. If it is unpaid, is it your expense or it is not your expense? It is expense outstanding. If you remember final accounts, it will form part of current year expense. It is not going to be next year expense, for this year only. So 16 only should be taken. Specific contract cost 5, it will be taken as such. 7 is the work executed, advance paid. 7 is not, 4 is not included in the 7. That mistake, don't do it. 7 is separate, 4 is separate. I take 7 totally. 4 I will not take because advances will not be considered. Further cost to complete is, okay, that is separate. For the total cost in the contract, I have to add these numbers. 12, 28, 38, 40, 45. 45 is the cost incurred till date. Please tell me the percentage on completion. 45 divided by total cost on the contract will be 80. If you will, if you do, you will know. 45 plus 35 plus cost to complete. So 45 by 80, 56.25%. Apply this on the contract revenue. 85 lakhs is the contract revenue into 56.25%, 47.8125, or I can tell 47 lakh 81,250. This is the contract revenue to be recognized. Is the class clear with it? In the 80, how did I get 45 is the cost till date. What is the cost to complete? Read the question. 35. If I add these two, I get 80. Okay, I should have read Mehta. I will go back to that question. On percentage completion method, this is our last question. Mehta Limited undertook construction of a bridge. Bridge will be constructed in 3 years. Details of the contract are as follows. Revenue 900 crores. Cost 800 crores. Any expected loss? No. That check needs to happen in your mind every time you read a question. Estimated contract cost 805 crores. Increase in revenue. In the second year, there is an increase in the revenue, 20. Increase in cost, 15. Contract cost incurred up to 1 year, up to 2 year, up to 3 year. Cumulative basis they are showing us. At the end of year 2, cost incurred includes 10 crores for material stored at the site to be used in year 3 to complete the project. So this 10 crore should be deducted from the cost of the second year. State the amount of revenue, expense and profit to be recognized. We will start with percentage of completion. Okay, let's begin. year 1, 2, 3. Cost incurred till date. That is only the numerator. We will start with that. Cost incurred till date. First year, the cost is, you have the handout. You can look at the handout. 161 first year. For the second year, 584 minus 10. 574 only will be written. For the third year, 820. What is the denominator? Total contract cost. Total contract cost. For the first year, total contract cost comes to, okay, total contract cost. They have not given directly, because there is some increase and all. So we will write next line item as cost to complete the contract. Further cost to complete. Then we will do add and then we will arrive at total contract cost. Total contract cost. Let us see how we are going to. For the first year, what is the cost to complete? Okay, they are giving you that the total estimated cost is 805. We will fill up whichever we know, okay? Then we will see how to move out. For the second year, what will be the total contract cost? If this is not required, we will score it off, okay? I have just written it the way the formula comes. What is the second year? What is the total contract cost? You know that, or you know to cost to complete. Whichever you know, we will write down first. What is the second year contract cost? 805. The question tells that there is an estimated additional increase in the cost, 15. So 805 plus 15, 820. In the third year, 820. This is not necessary. You can score it off. I wrote it just to make sure in your mind you go with the formula. Not necessary, scored off. Percentage of completion. See, in the exam, you need to decide what all columns will come, how to present the answer. That rationale will come only if you understand the logic of the calculation. You can't by heart all the tables and go sit there. So many tables, what all headings, how much will you remember if you by heart? First is 20%. 574 divided by 820. 70%. 100%. This is the stage of completion. Next we will do contract revenue. $805 into 20%. 161. No. Sorry. I've applied the percentage on cost. Sorry. You should apply the percentage on revenue. Revenue is 900 crores. 900 into 20%. 180. Is there a change in the revenue happening? Please check. Please check. Is there a change in revenue happening? Yes. In the second year, you will take 920 because there's a 20 increase into 70%. 644. Third year, 100%. 920. You need to find out the profit to be recognized. What is profit equal to? Revenue of each year minus cost of each year. Is the revenue given here each year revenue or cumulative basis? Cumulative basis. Leave a line and start. Contract revenue for each year. First year will be 180. Second year 464. $920 minus 644. 276. Contract cost for each year. $161 for the first year. 574 minus 161. 413. 820 minus 574. 246. 19, 51, 0, 30. That's all. This is the profit. This is the profit for each year. I hope you're comfortable with this model question. We are through with AS7, but for one last provision. Okay, Vikram, got these numbers? Whatever we are doing, accounting, contract revenue, contract cost, contract profit, this we learned how to find out. Now, one point you need to understand here is, going back to the same example, he has got a contract to construct a residential complex in Gudvancheri. He is also parallelly constructing another complex. I am only the person who is giving him the contract in Anna Nagar. So V1 has given a contract to V2. He is the contractor. If these two contracts is going on, accounting should happen contract wise. The revenue and cost should be identified contract wise. Profit will have to be determined contract wise, which means if these are two contracts, you will have two different calculations for the contracts. Yes. There are some cases where we can combine the contracts and then calculate the cost and revenue. I'll talk about combining the contract first, then we'll talk about segmenting later. Residential complex in Gudvancheri. Next to this, same in Gudvancheri itself, we are also constructing a commercial building for office. Two buildings are getting constructed in that same piece of land. Are we going to treat it as two separate contracts or single contract? For that, there is some guidance given in the standard. I will talk through the guidance. First thing what the standard setter tells is, when Vikram is coming with a proposal to me, telling that I will construct two buildings, that proposal, is he giving me separate proposals or a single proposal for both the buildings? That is the first checkpoint. Is a single proposal given for both the buildings, then you will treat that contract as a combined contract. Because the way he proposes, see, accounting is based on substance of the transaction rather than the form of it. So we are going into the substance of the contract now. If he comes out with a single proposal, we have to check first. Second, When we are negotiating over the price, he comes and tells 500 crores as a single proposal for both the buildings. When we are negotiating, I don't negotiate for residential buildings so much, for office buildings so much. We are not negotiating that way. Our negotiation is only on the total price. That is the second condition you need to check. Third condition, I will segmenting the contracts are so interrelated that it can't happen that I can drop out this or I can drop out this. Both needs to be constructed. There is no possibility of dropping one and picking up the other. If there is a possibility of dropping one and picking up the other, then it will be two separate. If contract is to be executed, both will be done together or both will be dropped also together. Three things I told you. One, proposal, only single proposal. Negotiation, also single negotiation thing. Or you construct all or drop all. You can't have an option that I will drop this, that okay, after 1 year he tells that I will do this and give, I can't do this. He can't do that option. If these conditions are satisfied, it's going to be combined. Is there any other condition I left out? Yeah, these are the conditions. Okay, with this understanding, we'll read this question. Segmenting the contracts also I will teach, but if I go everything in single stretch, no, it may get confusing. So we'll do one question as a break. This contractor undertakes construction of a commercial complex. He submitted separate proposals for each of the 3 units. A single agreement is entered into between the 2 parties. Proposals are separate. Yet a single agreement is entered. Agreement lays down the value of each of the units 50, 60, 75. Agreement also lays down the completion time for each unit. Comment whether it should be treated as a single contract or a separate contract. Separate proposals is the first thing. Second, can you find out for every item separate prices? Yes. Next, completion time is also different, which means it is not necessary that one building should be over and then the other building should start, or there's no nexus that if this is much is over, only then this will be the start. They are all independently, they can be completed. Independently, they are priced. So this will go as separate contracts. We'll read this answer. Separate proposals have been submitted. Separate negotiation is possible. Customer can accept or reject any of the items. The cost and revenue of each item is identified separately. If these 3 conditions are satisfied, then even though it covers number of assets, it will be treated as a separate construction contract. And then this is the final decision. Okay, segmenting the contracts I will take now. Provision wise, if you want, you can go through the study material. I am not making you write on the provision. If you understand, sufficient for me. Just the opposite of what I'm going to talk, what I spoke about in combine. First thing, you submit a single proposal. The price for the entire contract is fixed. Oh, I spoke about combining, no, before. Sorry, yeah. This question is on segmenting. Sorry, I told the heading wrong and I explained something. I told combining and I explained segmenting. I'm sorry about it. I will go over it. In my mind, there was something, but what I spoke was something else. I will revisit. Sorry for that. Separate proposals to be submitted. Everything I spoke about segmenting of contracts, whatever I told. I'm really sorry for that confusion. Treating it as separate contracts, I will again revisit. What I spoke about just now was on even though this contract is for 2 separate buildings. we are going to treat it as contract 1 and contract 2. The conditions which I told was separate proposals were submitted. So they are going to treat it as 2 separate contracts. Second condition, negotiation also we negotiated separately for these 2. So they are going to be treated as 2 separate contracts. Third one, we can accept one building if we want to, and we can reject the other. That means I may decide to cancel office building construction with Vikram. I may decide to give it to someone else. If that possibility is there, I am going to treat it as separate contracts. And fourth one, cost and revenue of each building can be identified separately. So whatever I told, understanding is correct. Only thing is the heading which I told was wrong. I told a different heading, but it should be actually whatever I told is, it will be treated as separate contracts. Okay, now I'll move to combining. Which means I will take another example. In Anna Nagar, the state government wants a bridge, and next to the bridge, a park to be made. So there is a construction contract for a bridge and also a park. This contract is given to, let's take Santosh. Santosh is the contractor. Is he going to combine it and see it, or separate it and see it? We have to discuss. When the government proposed to him construct this bridge and a park there, we approached to him as a single proposal. One proposal given in which we tell him construct a bridge and next to that a park also. So that if you see this Anna flyover, no, there is one small park also type. One small this Anna flyover, if you get down, no, there is one small greenery, some park also there. It's not exactly a park in your mind, but something where there is some plants, bushes, something. So something like that is what I'm, making you think. So there is a bridge. When you come down, there is some greenery space. Not where children can play. That kind of park, no. It's I'll take it as garden. I think garden should have been the word I use. A garden, small garden. Both put together, Santosh has to make now for us. We give him a single proposal. Negotiation also, single negotiation point. We are negotiating on the entire contract as a single negotiation. When he completes, he has to complete both. He can't tell I will make this but I will not make this, or I'll make this but not make this. No choice to him. So this contract, it has 2 items, but both can either be accepted or both has to be rejected. Price also both put together. Negotiation both put together. Proposal both put together. Then this is going to be looked at combined contract. If that bridge and park, the time to complete, the cost also, revenue, you can't identify asset wise. That is this separately, not possible. If that is so interlinked, in accounting also we will give it as interlinked or combined. That's all. Conditions, separate proposals. There is no separate negotiation. They are all interrelated, and they will be performed at the same time. That is, he will hand over this entire project to me together only. He can't hand it over separately to me. That means it will be combined. Okay, AS7 over. We are not breaking out. We are moving to the next standard. AS19. Yesterday in scenario based question, one question I did not do, no? You remember that time I told my mind is not working through the question. I will come back to it later. And I went home, I worked out the question. I was able to do it. Page number 10. I think that question only is what I vaguely remembered when I was going through this morning. Ninth question. Subha was absent yesterday. You were present. No, you were also absent. Online. You were absent. Yesterday we did all scenario-based questions. The entire scenario-based. You were. That's why I was wondering why you did. You only told scenario-based is very tricky, difficult, and you were absent exactly yesterday. Thing is, solution key also. If you go through, they'll give you A, B, C, D. If you don't know how A came, B came, C came, there is no workings to refer also in the study in whatever suggested answers. Ninth question only I remember. Okay, if you remember, you don't remember. Okay, I left one question, ninth question yesterday undone. I read the question, then I told no, I'm unable to think through now. I will come to this question. That question, ninth question on page 10 is based on AS 19. So today I'm going to revisit that question. I told now because if I forget, you are there to remind me that you come to that question, work out for us. Okay, you remind me. Now also I made one small, like one stupid error I made of combining segmenting.
Yes.
There is A7 now. Then wait. I didn't do it today. I didn't do it. Okay, page number 4. We'll look at that question. You read the question no, till I moved my soft copy to it. You keep continue reading. Try solving by yourself. It's a fixed price contract. Material, labor, unused material. Cost to complete 115. Payment received as a part payment of contract. You'll have to work out the question. You cannot directly do it. I want you to work it out in a notebook. There are so many elements of cost and all to be considered. If you do it, if you keep imagining numbers, you will only take extra time. First, you will find out cost incurred till date. What is the depreciation of machinery? You should be adding a depreciation element also. Machinery is used in the contract for 4 years. 125, 125, it's material purchased, unused material 22, 125 minus 22. I think that only should be taken as material consumed. Labor 95. This depreciation, whether to take per annum or all 4 years is what
4 years. Yes. Oh.
was 125 minus 22 plus 95, 198.
198.
That depreciation only, I tried both the ways, but I'm not getting these options, which is. Anyway, I will come back to this. I'll work out. Anybody getting the answer?
Ma'am,
Yes,
ma'am, I got a loss on contract 5 lakh.
you got loss 5. Huh? That's the correct answer, Sneha. How did you calculate?
Ma'am, I do it only on calculator, but I explain it.
Hmm.
1 second. Material cost 125 lakh
Hmm.
plus labor charge 95
Hmm.
plus minus unused 22 lakh.
Hmm.
Add further cost 115 lakh
Okay.
minus depreciation
How much of it?
210 divided by 20 into 4. 210
Ah,
divided by 20 into 4
you deducted
plus
this, huh?
add ma'am, add it.
That's
Cost.
42.
Yes ma'am. Total cost 355 lakh. We spent only 350 lakh. So loss on
Okay, okay. Plus 95 plus 115 plus 42. I did this, but I missed. 355 lakhs. 350 lakhs is the total contract price. So 5 lakhs loss. Yes, correct, Sneha. Good.
It seems easy and she explains.
Yeah, yeah. I also worked out the same way, but I don't know what I added, but I think in calculator. 4 years depreciation. Yes. Okay, so this is that question done. Okay, moving to AS19. I'll explain of AS19, then we will come back to the questions. Leases. When they start off by teaching you accounting of leases, this accounting is in the books of both the parties to the lease. Unlike the standard which we just covered, AS7, this talks only in the books of the contractor, not in the books of contractee. But here, lease accounting is in the books of lessor and lessee. Both is covered in this accounting standard. Both are covered. We have to understand what is lease. Then we will come back to accounting in the books of lessee and lessor. So I will start with lease. Lease is an agreement which gives the right to use an asset. Which gives the right to use an asset. This right is given to the lessee. Lease is an agreement which is giving the right to use an asset to the lessee for some consideration, for some payment. And that payment can come as a single payment or in multiple payments. Lease meaning not essential from an exam viewpoint. This lease accounting depends on the nature of lease. Nature of lease, the standard looks at leases as two different types of leases. One is called as finance lease and the other is operating lease. If you have already visited the standard, you will know that the standard defines what is a finance lease. And then it tells any lease which is not a finance lease will be called as operating lease. Question first type will be on deciding the nature of lease, classification of lease. That is the first model question. To decide whether it is a finance lease or not, there are 5 conditions to be looked at. Anybody who is able to remember the conditions? When will a lease be classified as finance lease? Okay, I will start. Before I start with the conditions, one thing to be kept in mind, the base idea of the condition is if significant risks and rewards of that leased asset is with the lessee. If I tell this, significant risk and reward have been transferred or not transferred. If I tell significant risk and reward is with the lessee, it means it has been transferred on account of the lease or not transferred? Transferred. If the risks and rewards of the leased asset have been transferred, then it will be called as a finance lease. Because see, as per the agreement, it is only a leased asset. For example, I have a plant and machinery. This plant and machinery I have leased out to Subha. So Subha is the lessee and I am the lessor. On seeing who has the ownership, we or S? Who has the ownership? We has the ownership. But when I tell risks and rewards are with the lessee, even though form of the transaction is that B is the owner, in substance it has been transferred. This kind of a lease is going to be called as finance lease. In whose books will this asset be recorded, this plant and machinery be recorded as an asset? In B's books or S books? S books. Why? Because significant risk and reward have been transferred. She can control the asset even though she is not the owner of the asset. On books, the owner continues to be the lessor, but in substance, she only is the owner. Is it an asset in her books? Yes. What is the asset definition? Asset is a resource controlled by the entity. Owned by the entity is not the word given as asset. Ownership is not necessary. If it can control the asset, it's yours. Hence, in the books of lessee, when she gets the asset, she will pass the entry as asset account debit to lessor account. She will not pay it immediately. If it is paid immediately, then it's a cash purchase. I have told the entry because it came in the flow, but I'm yet to cover the conditions. Okay, in my flow of the thing, I felt I'll finish off the entry also. Asset to lessor. I have to now discuss on conditions. I'm starting with the condition. First condition. Lease transfers the asset, the ownership of the asset, to the lessee at the end of the lease term. Please note, lease transfers ownership. It's not lessor transfers the ownership. The lease agreement itself is framed in such a way that let's take I have given the asset on lease to her for 5 years. After 5 years, I will transfer the asset to her. It will become hers. The lease is transferring the title of the asset or ownership of the asset to the lessee at the end of the lease term. At the end of the lease term. So she will use it. At the end of the lease term, it will become hers. Second point. Lessee has the option to purchase the asset at a price lower than the fair value of the asset at the time of exercising the option. Lessee has the option to purchase the asset at a price lower than the fair value of the asset at the time of exercising the option. I will just explain this point. Generally, exam questions don't test you on this. This provision is not tested. At the end of 5 years, it does not become hers. It directly does not transfer to her. She has the option that she can purchase the asset. If she has to purchase, she has to pay a price. Let's take she can purchase the asset at 1 lakh rupees. That is given in the agreement. Fair value of the asset at the time of exercising the option, which means when she decides at the end of 5 years, the fair value, which means the market price of the asset at that time, will expectation is it will be around 70,000. Sorry. This will be 1,70,000 fair value. Market price is 1,70,000. She can purchase at 1 lakh. Will she purchase the asset? At the time of inception, we presume that if she is getting an asset which is worth 170 at 1 lakh, Subha will purchase the asset. This is what we are able to assume. If this is the case, it will be called as a finance lease. Automatically, ownership is not getting transferred. She has the right to purchase, but we presume that she will exercise the right. She will not lose that right, or she will not lapse it. If that is the scenario, the asset is going to belong to her only. We will take it as a finance lease. Okay. Third thing, the lease term. This will be covered in any exam question. This condition is generally covered. The lease term covers a major part of these conditions. Should be learned. The words you should know how to present these statements. These term covers a major part of the assets economic useful life. Sorry, economic life. Don't write useful life. Assets economic life. Assets economic life. The lease term covers a major part of the assets economic life. Total life of the asset is, let's say, 6 years. Whether Subha uses it or if she does not want, someone else also uses it, total economic life can only be 6 years. After 6 years, it can be of no use. And the lease term is covering 5 years. In this scenario, we will presume that she is using up the entire economic benefits of the asset. So it is going to be considered as a finance lease. After her, nobody can use it because only the major part of the economic life is used by her itself. Okay. So third condition, lease term covers a major part of the assets economic life. Fourth condition, you will generally not use it in the exam. Third and fifth only will be tested in an exam question. The asset is of a specialized nature. The asset is of a specialized nature that only lessee can use it without major modifications, without making major modifications. This plant and machinery is such that it can be used only by her. If someone else has to use it, it may not be directly usable. They'll have to make a lot of changes to it because this is being manufactured according to her specification. She has a particular factory area. In that factory area, she has so much of space to install the machinery. So I created a very big size of plant and machinery. The height also depends on her factory building. According to that, I customize the height of the machinery. Second, according to her capacity, she wants a capacity of 1 lakh or say 10,000 units per day. According to that, I customize the machine. It's a very customized machine for her. If anyone else has to use it, they'll have to modify it. If that is the nature of asset, then it is going to be called as a finance lease. The point behind finance lease is it is such asset which only can be used by her, and it will become hers only at the end of the year. Even if it does not become hers, the entire benefit of the asset, she only can use it. If that is the case, it will be recorded as a finance lease, which means it will be recorded as an asset in her books. Fifth point. This is only the most important point from my examination viewpoint. Present value of MLP substantially covers the fair value of the asset at the inception of lease. PV of MLP substantially covers the fair value of the asset at the inception of the lease. I'm repeating the 5 conditions now. First condition for deciding whether it is a finance lease or not. Lease transfers the ownership of the asset to the lessee at the end of the lease term. First is automatically transfer. Second, lessee has the right to purchase the asset at the end of the lease term or any time. Lessee has the right to purchase the asset at a price that is lower than the fair value of the asset at the time she exercises the option. Whenever the word fair value comes, fair value as on what date you will have to complete it. There are 2 fair values in this entire 5 conditions. Second condition as a fair value. Fair value, what is the date? Fair value as on the date of exercising the option. Now we'll come to the 5th condition. There is a fair value again there. Third condition. The lease term covers a major part of the asset's economic life, which means the lease term will, the asset's economic life, if it is 6 years, lease term is covering a major part. Major part should be considered as something 80% or more than that will be considered as a major part. Fourth condition, asset is of such specialized nature that only the lessee can use it without making major modifications. Fifth one, present value of MLP substantially covers the fair value of the asset at the inception of the lease. This point we will see it in a question. We are moving to questions now on classification. There are many model questions under AS19. AS19 coverage is pretty much, but RTP and whatever RTP questions and past exam questions covered, they are pretty minimal model questions. So my handout also covers only whatever models covered by past exam questions and RTPs. What I'm going to say is all the models are not covered here. Only models which are covered in RTP and past exam only covered. Yes, 19. I will read which question first. 33rd question we'll do first. RTP May 25. The RTP relevant for your examination. What, Santosh? Whom are you texting? Not texting. Sun Limited wishes to obtain a machine costing 30 lakhs by way of a lease. The effective life is 14 years. Effective life, economic life. But the company wants it only for 3 years. Here itself you can decide that it is not a finance lease. It enters into an agreement for a lease rental of 3 lakhs per annum payable in arrears. Implicit rate of interest is 15%. you need to decide on the accounting of lease rentals. Lease rentals accounting will depend on whether it is a finance lease or operating lease. So the question is on deciding the nature of lease. Can we repeat the conditions? What is relevant for this? The third condition, can we just repeat it? The lease term covers a major part of the asset's economic life. Here, lease term is equal to 3 years. Asset's economic life is equal to 14 years. Therefore, the lease term does not cover the asset's economic life, does not cover a major part of the asset's economic life. That's the first argument. Second argument. I will show the suggested answer afterwards at the end of the discussion. Okay, I'm moving here. PV of MLP. For this, you should know what is minimum lease payment. MLP is nothing but minimum lease payment. I have to tell you what does minimum lease payment mean. Minimum lease payment means the entire payment that happens during the lease term and at the end of the lease term, both put together will be called as minimum lease payments. During the lease term, payment means for now you are going to understand this from lessee viewpoint. Okay? I'm going to take accounting lessee viewpoint, then only come to lessor viewpoint. During the lease term, what does lessee pay? Lease rentals. So, during the lease term, payment made is lease rentals. At the end of the lease term means you will take it as residual value. There will be a guarantee given by the lessee. A guarantee will be given by the lessee that on the residual value. I don't want to get into GRV in detail for now because again it's only a revision class, only. I don't want to get into the concept now. MLP meaning alone I will just tell. In the exam question you need not know what is GRV. They'll tell you that this is the GRV. Pick up the number and use it. That's all. MLP is lease rentals plus GRV. Guaranteed residual value. Then they will tell you total residual value is, let's take 1 lakh rupees. Total residual value is only 1 lakh. Guarantee given by the lessee is only to the extent of 670,000. So the balance 30,000 is the portion which is not guaranteed. We call it as UGRV. Okay, there is something called UGRV. Keep it in mind. I'm not going to use UGRV now. UGRV is relevant only in the books of lessor, not in the books of lessee. I am doing lessee now. 3 terms you should know. MLP is equal to lease rentals plus GRV. That's all. Don't think of UGRV. Keep it out. Coming back to this question. Okay, it's not. In this question, what is the lease rentals? 3 lakh per annum. Is there a GRV given in the question? In this question, no guaranteed residual value is there. There is no GRV. Only lease rentals. But that lease, so GRV will be taken as 0 in the absence of information. If you find out MLP year, during the lease term is 3 years, okay? It is 3 lakhs per annum. What you need for deciding whether it's a finance lease is present value of the MLP. Please find out the present value. These cash flows arise at different timelines, year 1, year 2, year 3. Bring it down to the present value at year 0. The cash flows given is year 1, year 2, year 3 cash flow. You have to bring it to year 0. The PVAF is given to you as 3.36. So you will do 3 lakhs into 3.36. 10.08. Fair value at inception of lease. You need to compare it. At the beginning of the lease, fair value, what is it? Is the price at which you purchase the asset. At that time, when you started the lease, at what cost did you purchase? 30 lakhs. Now do 10 divided by 30. Does it cover more than 75%? Is it more than 75%? Does it cover does it substantially cover? It is not, it does not cover substantially, so it is not a finance lease. It will be an operating lease. The fifth point, PV of MLP. PV of MLP substantially covers the fair value of the asset. Fair value date, every time you write fair value, there is a date attached at the inception of lease, which means the fair value at the date you start the lease. When I begin the lease, the cost is 30 lakhs. So this is considered as the fair value. How much is lessee paying over the lease term? The lessee is paying lease rentals plus the GRV. Yeah, in this question, but I'm just covering as a concept, okay? The entire amount, if she pays off nearly the cost of the asset, is her intention of just renting out the asset, or she is actually wanting to own the asset? The standard setup is that if she is nearly paid the cost, it means she wants to own the asset. The purpose is not renting. So she should nearly pay off the cost of the asset. Only then it will be treated as a finance lease. Substantially covers lease rate. So if I have to compare this with the fair value, they are on two different dates. This is at the inception of the lease. This is in timeline year 2, year 3. So bring it down to the present value, year 0. So PV of MLP needs to be calculated. Then we make a comparison between these two. If PV of MLP substantially is equal to at least 80 to 90% of the fair value is covered by MLP, means it is a finance lease. Anyway, we will do this. All the questions which I'm going to do is going to cover on this model. This question over. If you look at question number, there is a repeat on this model. Suraj Limited, 35th question. It's of the same model. "14 years economic life, 3 years only," same thing. Numbers also same. Nearly same. Okay, so this is also covered, finished off. Suraj Limited question is also done. Now I'm moving to the next model question. Padma, hi Padma. I don't know whether you were present before. Classification of lease is the first model question. Types of questions, no, I want to list out. Type 1. Type 2, I have not included in the handout. Only this morning when I was revising, before coming to class, I just realized that I did not include type 2 model. Accounting in the books of lessee. Type 3, accounting in the books of lesser. These are the types. I'll cover off accounting in the books of lessee. Provision wise, I'll cover it off. In the books of lessee, there are two phases or two stages in which we will discuss. First phase is on inception of lease. How do we record this asset? All which I'm talking about is finance lease. Operating lease I'm not covering now. Higher chances of questions being asked only on finance lease. Operating lease, if it comes, it will come only as MCQ. They can't ask you in a full-fledged question. Operating lease, it's too simple to ask here. On inception of lease, what accounting should you do? During the lease term, what accounting you should do? Are the two types of questions under this model. On inception of lease, this only more number of questions are there in the study material. Only one question of this model is there in the study material during the lease term. On inception of lease, the lessee will pass the following journal entry, which is asset account debit to lessor account. Debit the asset which is coming in, credit a liability to pay to the lessor. The amount at which you should pass the journal entry needs to be understood. If you're done with copying, I'll take you through the amount. As per PPE. Now, PPE also talks about asset only. What is the difference between that? PPE talks about what kind of asset? Asset which you purchase. Here, the asset is leased out. Leased out asset should be recorded at fair value. Okay, there are two options, this or this. Here, the asset should be initially recorded at fair value. As on which date? Whenever you write fair value, you should write the date. As on the date, on which date are you passing this journal entry? Inception of lease. That is the date. The date is called as inception of lease. Fair value as on the date of inception of lease. Or PV of MLP, whichever is low. Are you able to recall learning like this? Not able to. You are able to recall? I did not include this model question. No, that's why I am now going to study material to search for a question. I did not notice that I missed. Module 2, Asset-Based Accounting Standards, AS 19. If you ask me any standard which is law, which is a very technical standard, means I would tell AS 19 is a very technical standard. It has a lot of terminologies involved. I will just show you one model question, no, of this type. We will read and understand. Okay, we'll go through this question. How is the question worded also you should know, no? Otherwise, I just did the provision and then I tell you will be able to understand. Nah, it's not fair on my part. Let us look at the last line in the question. Calculate, we'll do it in, I will download the copy. If I touch it will. Please make sure you go and read the standard. I request everybody to go and read the standard. It is one thing, it is technical. Whether it's important or not, I have no say on that. Institute has to decide whether it's important, but it is a very technical standard. If don't go through the provisions if you don't have time, but at least go through all the illustrations and the exercise questions. If you read that much, sufficient. The question will be worded like this: calculate the value of lease liability, or they can ask you calculate the value at which asset will be recognized. Both. Why they can ask you any of it is whatever amount you write here is the same amount you write even for liability. Asset and liability are recorded the same number because that is the journal entry. This question is on liability. Let's read it. Lease term 4 years. Fair value at inception 20 lakhs. Lease rental 6 lakh 25 per annum at the end of the year. GRV 125. Expected RV 3 lakh 75. Which means there is a UGRV also in this question. UGRV you're not going to use because it is in the books of lessee. How do I know it's in the books of lessee? They're talking about lease liability. Lease liability only lessee will have. Lessor is not going to have any liability. That's how I understand it's lessee books. Next, 15% is the implicit rate. Discount rates are given to you and they're asking you to find out the value of lease liability. The asset. Now let us look at the provision here. The lessee should recognize the lease as an asset and liability at the same number, at equal amount. And what is that amount? Fair value of the leased asset at the inception of the lease, or PV of MLP, whichever is lower. This is an easier way of telling the sentence, apart from this. Here the sentence is made complex. Lessee should recognize the lease as a liability, as an asset and a liability. Full stop. Then you should write, it should be recognized at fair value of the leased asset at the inception of lease, or PV of MLP, whichever is lower. Can we calculate PV of MLP in our calculator now? 6,25,000 is the lease rentals. You do the PVAF way, 1 divided by 1.15 equal to M plus equal to M plus equal to M plus. 4 years is the thing. If you want, you have the discount rate rates also. I want us to finish off in the calculator itself. You get 3.352? Huh?
2.85.
Oh, I don't know how many times I did actually. 1 divided by 1.5. 1 divided by 1.5. 1, 2, 3, 4. 2.85. I did one time extra. 2.85497. 2.855. We can round it off as 5 also. 2.855 into lease rentals of 6,25,000. You will get 1784375. Yes, I note down this. Next, I have to do the GRV also. No, MLP is nothing but lease rentals plus GRV. GRV discounted at the last, this 5.5718 we discount. GRV is 1,25,000 into 0.5718, 71475. You will check whether we're getting this answered. Are you getting the same thing? She got okay. I'm taking only for the benefit of you all. She is nearly understood. So, are you getting? You got? Okay. So 1855850. This is the value at which you recognize the lease liability. That's all. Question is over. Can I move to lesser books now? In the books of lessor, what will be the journal entry which he will pass to asset account? Asset is going out. Lessee will be recorded as the debtor. This will be recorded at net investment in lease. Can we just read this sentence? Lessor will recognize the asset lease receivable in the books at an amount equal to net investment in lease. Okay, anybody who tells I know what is net investment in lease? Okay, you have no idea? No idea at all? No? Okay, then I'll start explaining the term. Net investment in lease means is equal to present value of gross investment in lease. I started with one term, net investment in lease. You ask me what is net investment in lease, I will tell you that is the present value of gross investment in lease. So one term you ask me, I have given another term. Now this second term I have to explain what is gross investment in lease. I will continue writing as an equation now. Present value of, I have to define gross investment in lease. Gross investment in lease means MLP. What is MLP? That I know.
Lease rents plus
Give me
GRV.
that equation again. What I told you. What is MLP?
Lease rents plus GRV. Guarantee.
Okay, lease rent plus GRV. I will come back. I will come to another statement and complete it. Okay. MLP plus UGRV. That is only gross investment. Which means nothing but, now I will break it down to the least. Okay. This is the last step. Lease rental plus GRV plus UGRV is gross investment. Lease rentals plus the total residual value, whether guaranteed or unguaranteed portion, entire residual value put together will be the gross investment in lease. Three components of gross investment in lease. Lease rental plus GRV plus UGRV, add all of that, you will get the gross investment. If you bring that gross investment down to the present value, you will get it as net investment in lease. This formula is very, very important to stay in your mind. I'm going to work out 2 questions on this model. We are moving to questions. Whatever RTP question I saw are on this model. Major questioning is only on this model. What they will ask you in this question is, classify lease. For classification of lease, we will have to use that formula. How? We will understand the question. We are reading this question. Color Limited leased a machine to Red Limited on the following. Cost is given to you. Lease term 3 years. Fair value 18 lakhs. Cost and fair value are the same here, which means this fair value is at the inception of the lease. UGRV 2 lakhs. IRR is nothing but to find out the present value discounting procedure for the 12%. Expected useful life is 5 years. Machine will revert back to Color Limited on termination of the lease. Lease payment is made at the end of each year in 3 equal parts. Lease term, how many years? 3 years. Economic life of the asset, 5 years. 3 divided by 5 in percentage form comes to 60%. It is, whether it's major part or not so clear. It's only 60%. Which under condition I'll have to check. Why I'm talking, okay, I forgot to read the last line of the question. Please read the last line. You're required to analyze whether the lease constitutes finance lease. Then you also have to calculate something. Forget of that, that is another term. Don't get into too many terms, so I did not cover that term now. Still, we don't know that term. What all terms we know in lessor books when we come to accounting, we should record it at net investment in lease. What is net investment? Present value of gross investment. What is gross investment in lease? Lease rental plus GRV plus UGR. So far, you know only these terms. We have to decide on the nature of lease. Can we go over the condition? First condition, lease transfers the ownership of the asset to the lessee at the end of the lease term. Second, lessee has the option to purchase the asset at a price which is lower than the fair value of the asset at the time of exercising the option. Third one, the lease term covers a major part of the asset's economic life. Fourth, asset is of such specialized nature that only the lessee can use it without making major modifications. Fifth one, very important, PV of MLP is substantially lower than the fair value of the asset at the inception of the lease. We are going to work out this question. We will start. Please write it in your notebook. Handout is in front of you, so the numbers are there, even if the question is removed from screen. Under construction contract, percentage completion important. Under this standard, lessor books accounting important. To decide the nature, you are just listening to me first. To decide the nature of lease, we need present value of MLP. Fair value of the asset, we have some information. Okay, we need not calculate. PV of MLP. Present value of MLP, I don't know. Why? Because look into the question. Do you know what is the lease rentals per annum? In the previous question, whatever Sun Limited question, you know lease rentals per annum. Right now, we did the Square Limited question from the study material. Even in that, lease rentals per annum was there. In this question, that is missing. Hence, we are. But how much?
Cost by 3.
You can't do. You can't do that. Because cost by 3, it cannot do, because there's also a GRV, there is residual value also. That will not be right. See, when you are giving the asset for a 3-year term, you are not expecting to receive only cost. You want something extra by way of interest. So, cost if you divide by 3, that will not be lease rentals. I will make a loss. There's no point in giving a lease. Okay. PV of MLP to determine, we are going to use this formula. Net investment. Please start writing down in the notebook. Santosh, start Santosh. You're getting so bored. Yeah, he's feeling bored. He's like, when is this class going to get over? I don't know. This is all nothing. Costing revision class is going to be from morning 6 to evening 6. 12 hours class. Dinesh sir is planning. And you know Dinesh sir's speed also. Net investment in lease is equal to present value of gross investment in lease. Now, go ahead. PV of the gross investment, we'll split it now. MLP, bracket close. Okay. We'll write it full. Okay. I'm skipping this step. PV of MLP plus PV of lease rentals. Sorry, I wrote the wrong word. Lease rentals plus GRV plus UGRV. Okay, net investment in lease is nothing but fair value. It is, see, you have one X figure, this one. Net investment in lease meaning, okay, I did not cover this. Net investment in lease means what? The value of the asset at the inception of lease. There are two ways in which net investment in lease can be defined. I only went for one definition. The other way of defining net investment in lease is, net investment in lease is nothing but the fair value of the asset at the inception. There are two net investment in lease formula. Confused. Santosh looks very confused. Net investment in lease. Two ways of looking at it. One is PV of gross investment. Another is, it can also be called as fair value at inception. There are two ways of looking at net investment. If I do not know net investment and I do not know lease rentals, I cannot solve this equation. I can only have one X to solve it. So what I'm going to do is, net investment in lease is there in the question. Fair value is there. So we will again repeat this formula now. Fair value at inception. Instead of net investment, we substitute by the word fair value equal to. Now you will write it this way. PV of lease rentals, bracket close, plus PV of GRV, bracket close, plus PV of UGRV. I am splitting PV off for each of the items, because now I am going to start substituting numbers. Please search for fair value. 18 lakhs. PV of MLP, sorry, PV of lease rentals not known. That only we are going to find out. So we just write PV of lease rentals. We do not know what is per annum lease rental. GRV in the absence of information taken as 0. UGRV there, please discount it. UGRV is going to come at the end of the lease term. Lease term is 3 years. The discounting factor is given to you in the question, 0.7118. 2 lakhs into 0.7118. 142360. Please solve for PV of lease rentals. $1657640. I need lease rentals now. This is the present value. I need from present value, I need the lease rentals. How to find out? Okay, if I give you lease rentals and I ask you what is present value of lease rentals, how will you find out lease rental into PVAF? 1657,640. See, if I gave you lease rentals and then asked you to find out the present value, you will do whatever cash flows into PVA. Now I am asking you to find out LR. How will that be found out? PV of LR divided by PVAF. Not making sense. It's totally financial management concept. PV of lease rental is equal to lease rentals arising, that is different cash flows, multiple cash flows, same number, it is annuity. So this into PVAF. This is what you did under square limited question, no? For Square Limited, what did we do? This was given to us, 6,25,000. 6,25,000 into the PVAF factor we did. Now what I'm asking you to find out is present value is known to you. So we have to find out lease rentals. How will you find out LR? PV of LR divided by PVAF. So you will do 16,57,000. 16,57,640 divided by PVAF factor is given 2.4018. Are you getting this answer? 690,165.71. So this is only the PV of MLP. PV of lease rental, sorry. Not PV of lease rentals here. LR is equal to 690,165.71. This is only the lease rentals. Now we will classify the lease. Can we repeat the condition? What is the fifth condition? PV of MLP is substantially equal to the fair value at the inception of the lease. What is the fair value at the inception of lease in this question? 18 lakhs. What is the PV of MLP? GRV 0. So PV of MLP is 1657,640. Able to see it? MLP is nothing but lease rentals plus GRV. GRV 0. So PV of lease rental will be PV of MLP. Now check whether it substantially covers fair value. Please check the percentage. 1657,640 divided by 18 lakhs. Percentage 92.09%. Does it substantially cover? Yes. Anything more than 90% substantially covers. Look at the way presentation happens. PV of lease payment MLP equal to 92.09% of the fair value. PV of MLP substantially covers the fair value of the leased asset. The same provision repeated here. Next, lease term 3 years. It covers a major part. That's how the study material interprets everything. Anything more than 50%, it tells that it covers a major part. That's how study material interprets. Therefore, it is a finance lease. This is done. I have to introduce one last term. With this, all the terminologies I'm through with in this standard. What all terms I spoke of? First, I started with the term MLP. What is MLP? Lease rentals plus GRP. Where is MLP? Okay. MLP, after we looked at this, next what we looked at is present value of MLP. Where did we use present value of MLP in accounting? In lessee books. How did we use it in lessee books? In this journal entry, asset to liability. What will be the number here? PV of MLP or fair value at inception, whichever is lower. At that value in lessee books, we do the initial recognition. Then I move to lessor books. In lessor books, I told this journal entry will come. Lease receivable to asset account. What will be the amount here? Net investment in lease. That net investment in lease, there are two ways of interpreting it. Okay. First way, this is what I taught you. Net investment is equal to present value of gross investment. Then present gross investment means what? Present value of lease rental plus GRV plus UGRV. Net investment can also be fair value at inception. So far done. Now last term. Gross investment in lease minus net investment in lease is equal to finance income. Why finance income? In whose books we are going to find out this? Lessor books. Gross investment, net investment, these terms itself will come only in lessor books. For lessor, this entire transaction is going to result in an interest income. Interest income is called as finance income. I have to make some more modifications to that word. Finance income. The total finance income on the lease is nothing but gross investment minus net investment. Why means on the entire lease, whatever amount I am going to earn is represents GI. Total amount that I am going to earn in the lease. Lease rent plus GRV plus UGRV. This is the total money I will receive in the on the lease from the lease. Minus net investment is nothing. Otherwise, the word is it is the cost of the asset. Fair value of the asset, cost of the asset mean the same at the inception. So by spending 30 lakh now, I'm able to earn 40 lakh from the lease, which means that 10 lakh is my finance income. That term will be called as unearned finance income. Gross investment minus net investment is equal to unearned finance income. That's the last term in your mind. Okay, so please write down the formula. Unearned finance income is equal to gross investment in lease minus net investment in lease. You have not come across these terms? You studied? You did self-study. Yeah. You are aware? In this question, please calculate then. You are aware, no? Calculate for this question and tell me what is the unearned finance income. Please show the calculation for gross investment in lease. Gross investment does not happen at PV. It's not at present value. Gross investment is equal to lease rental plus GRV plus UGRV. Please substitute in this formula. Find out the gross investment. I'm not working out. I'm waiting for your answer. Santosh, answer. Quick, yeah. Should not take so much of time. All the numbers are in front of you. What big calculation you're going to do? Subha, answer. What is that? Unearned finance income. No. Durga. What is lease rentals here? 690,166. I will round off that way. Okay. Same with the 690,166. They have not rounded off. Okay, I'm rounding off. Into how many years lease term? 3 years. So total lease rentals is 2070498. GRV is 0. UGRV, I don't need present value. I am taking the cash flows as such. Plus 2 lakh comes to 22,70,498. The fair value of the asset at the inception, which is net investment, is 18 lakh. So unearned finance income should be 470,498. Username, don't know, left out.
What is this lease rentals we are calculated as per 1 year or it is
For 1 year, per annum. Yeah.
for 1 year we have to take for calculating net interest.
Because we divide by PVAF, no? So we get annuity per year. That. The same form, the formula. I'm trying to go back to the workbooks. I don't know where I wrote it. Okay, I will do it all. I don't know where. PV of LR is equal to LR into PVAF. When you did this LR in that S square limited question, what was this? Per annum only. So what you get is per annum. Because LR which you get is per annum. When you do PV of LR divided by PVAF, you get per annum. Same model question, can we do one more? Question number 34, money limited. Fair value 24 lakhs, lease term 5 years, lease rental per annum 4 lakhs, guaranteed residual value, expected residual value, IRR. Ascertain unknown finance income. Okay, this is not of the same model. Lease rental per annum is given to you. We can do it in the calculator itself, okay? Unknown finance income is asked. What is unknown finance income formula? Gross investment minus net investment. What is net investment? Is it given directly in the question?
Fair value of
Fair value of the machine given. So what should you calculate? Gross investment in lease. Let us calculate gross investment in lease. Lease rental per annum is 4 lakhs. 4 lakhs into 5 years. 4 into 5, 20. Put it in M plus. Plus GRV, 0.8 M plus. UGRV will be 0.7. Able to understand? M plus. MRC, 21.5 you get. This is the answer, 21.5. This question, no, is it's not completely typed. They are okay. They are not taking net investment in lease as fair value. Because in that question, lease rental was X. In order to complete that equation, we just made an assumption that net investment in lease is the same as fair value. Since this information is given, they are not making that assumption, they are calculating the net investment in lease. In that question, lease rentals was missing. That's why we assumed net investment to be fair value. Here, let us calculate net investment in lease. Net investment in lease, let us write the formula. Net investment in lease is equal to PV of lease rentals plus PV of GRV plus PV of UGRV. 4 lakhs is the lease rental. You will have to find a PVAF factor. 1 divided by 1.15 equal to M plus, like this 5 times I'll do. 2, 3, 4, 5. 3.352. So 3.352 into 4 lakhs. 1340862 plus GRV in that question is
Point, I then see the
0.7. Sorry,
Yeah.
0.8. 0.8 into the last year PVF factor is 0.4972. Point 39776. Point 39776. That is in lakh terms you have to take, no? All these amounts are given in lakhs. So into 1 lakh. Are you getting 39,776?
Yeah.
Yes. GRB is 0.8, which means 80,000 into the factor for that year 0.4972. If you do that, you will get 39776 plus UGRV is 0.7. So 70,000 into 0.4972. 34804 plus 39776 plus 1340862. 1415442. Okay, maybe
round off.
some small round off. You would have round off some. I'm not getting this. 34804. Yeah, 39776. Which means this is wrong in my computation. This is PV of MLP. Do you get this one? 1340? No. What did you get for lease rentals present value? Huh? 800. Huh? You also got this 13. Add up all the 3 numbers. What does it come to?
One, 4, 5, 3, 8.
I don't know why they're getting this one. Okay, this minus what is the gross investment in these minus 21,50,000. We are getting 6,34,620. Point 869. What is the discounting factor we have taken? Have you noted down PVAF? 352. This is the same number which they have taken, 3.352. All the numbers are the same. This also, if I add it, comes to 3.352 into 4 lakhs. 1340880. Nearly same. There is some computation mistake in this. These 5 numbers, let's add. Just add and check, no? These 347,840 plus 302,440 plus 263,000 plus 228,720 plus 198,80. There's some addition mistake only. If you add all the numbers, you don't get 1345. There is a mistake in the solution. These numbers itself, which is shown, no, if you add all that, it comes to 1415460. There is a mistake in the solution. What we got is correct. Okay, there is a mistake in the solution. Where is this? RTP Jan 25. Okay, there is a mistake in the solution. This question also same model, no change. It's the same as what we did previously. Okay, so we are done with the 3 standards which we had planned for today. AS7, AS19 and I have to do AS4.
That question 9 in case-based question, ma'am. MCQ.
Yeah. That is on operating lease, that question. Page 4. I've wrongly titled it as 7. It's actually AS9. No, this. Page 10. This one. A machine is given on 3 years lease by a dealer of the machine for an equal annual rental to yield 20% profit margin on cost of machine, which is 3 lakh. This is a 3-year lease. 3 lakh is the cost of the asset. Economic life is 5 years. Estimated output from the machine is in 5 years is as follows. They've given you 5 years output and they're asking you to find out what is the annual lease rent. How you should approach the question. ₹3 lakh is the cost. Plus the margin we have to add to this. 20% margin on cost. So I can directly apply. It will come to 3,60,000 rupees. This is the total amount inclusive of the margin. This we are going to recover from the lease. Over what is the total output over 5 years time? Sorry, the lease term is only 3 years. What is the total output over 3 years time? 1,50,000. Now 3,60,000 is the total value of the asset. This can fetch you or give you benefits for 5 years. Over 5 years, what is the output? No, over 5 years, calculate. Over 5 years, what is the output? Are you getting 3 lakhs? This value of 3,60,000 by using it will give you benefit for 5 years. Total output that you can manufacture from this asset is 3 lakh units. Over the lease term, what is the estimated production? 1,50,000. 3 years production is only 1 lakh. So what will be the value for this? How much value we can recover from the lessee? 3,60,000 into 1,50,000 divided by 3 lakhs. See, we cannot recover entire 3,60,000 from the lessee. It will be unfair because he is using only for 3 years. So accordingly, for 3 years, based on output, we find out the proportionate cost is 1,80,000, inclusive of the margin. Now this they are going to recover over 3 years' time in equal installments. Question tells equal annual payments. So divide this by 3, 60,000. That is the answer. Okay, I'll just quickly cover AS4. Questions you will go through at home. The solutions, I will share the solution file with you. You go through at home. AS4 talks about events occurring after balance sheet date. These events are divided into two. One is called as adjusting event and the other is non-adjusting event. If you give the answer that it is an adjusting event, when what is adjusting I'll be covering. If the answer comes as that event is an adjusting event, we will give effect to it. Or I can tell that we will modify the asset and liability balances. That means we will account for it in the books. If it is non-adjusting event, it will not affect, or I will not modify. It will affect the asset and liability balances. If it is non-adjusting, it will not affect the asset and liability balances. We will not give effect to it. It will only be disclosed in the director's report. There will be no impact of it in the balance sheet. What is an adjusting event? Point number 1. The condition existed in the balance sheet date, existed as on the balance sheet date. The event that happened, event gives additional information of the condition that existed. Event gives additional information of the condition that existed on the balance sheet date. And the amount is significant. Example, some debtor balance is there outstanding as an asset in the balance sheet. We think that it's been long since this person is not paying money. We have been sending constant reminders. So we are doubtful whether this amount will be receivable or not. Before the date of approval of accounts by the board, see the date of approval happens on 1st June. Before the date of approval, we come to know that this person has become insolvent. In that case, what we will tell is condition was there, whether it was going to come or not. The event that happened after the balance sheet date is confirming that he's not going to give us the money. It is giving us additional information that this money is not going to be recoverable. In that case, we will give effect to this loss in the balance sheet. When did we come to know about this? Only after the balance sheet date. But since it is an adjusting event, we will record the loss in this year itself. We will not wait for the next year to record it. Now next, another example. There is a fire breakout happening in the month of May. Did this condition exist as on the balance sheet date? Did we know that fire is going to happen? We did not know. Any additional information not relevant because we did not know itself that about the condition. So this will go as a non-adjusting event. However, even though it is non-adjusting event, if it is going to affect the going concern of the entity, it will be treated as an adjusting event. We will give effect to it in the balance sheet. So non-adjusting event means what? The condition did not exist on the balance sheet date. That's the meaning. But if it is non-adjusting, still if it is going to affect the going concern, it will be given effect in the balance sheet. You can go through the solutions for this. I don't think there is any much difficulty in understanding AS4 standard. That's why I had kept it towards the end, that whether I cover or not, I don't want to leave any important, there is difficult standard. AS4, whatever are the questions in the material, I will share the answer key with you. You can go through and check whether you're able to understand. Okay, so we will end the revision class here. The class with me, we will